portfolio policy for an enterprising investor. Specifically, what not to do. What you don't do is as important to your success as what you do. Do. So it's very important to avoid losing money, at the same time making mistakes that are known to lose a lot of money. So that's what this chapter is focused about. What are some of those checklist items that even an aggressive, enterprising investor should avoid? So the number one thing is day trading. It's probably the best weapon built for a financial suicide. You lose a lot of money because of fees, trading commission, and whole host of reasons there are for you not holding stocks for like hours or days. Um, an intelligent investor is an investor who is in for the long term. Preferred stocks are best left for institutional investor. It has a lot of complexity involved. Typically, only if it's available at a 30% discount or more, that's when you go in, and a lot of complexity is involved. The biggest one is the new offerings or the IPOs, which was a key learning for me from this entire chapter. We tend to remember a lot of vivid examples of recent IPOs that went very well. In the 1990s, it was Microsoft. A lot of recent stocks like LinkedIn, Facebook went really well in the initial offering. So that's what clouds our judgment when it comes to new offers that are probably not as profitable, like Uber and a whole host of other new companies whose earnings per share is actually negative. So it's very important to avoid IPOs, very important to avoid inferior junk bonds and foreign government bonds. Let's go deeper into IPOs. The big part is that these are really sold when markets are at all-time highs, because the sellers are selling after a long period of holding, and they'll sell it at the best price. The underwriters, the banks, the private equity firms have a huge margin that they make money when they bring some of these new companies to the market. A lot of selling happens from these banks in terms of pushing the customer to actually buy. So there's a lot of correlation and studies done to prove that peaks of market bull runs are around peaks of IPOs. And there's also studies that show that it's underperformed index over a long period of time. There is no proven track record. There is no public accountability of what happened when they were in private stages. So an IPO or the new offering is not an initial public offer. It's probably overpriced. IPO, it's probably overpriced. IPO, imaginary profits only. IPO, insiders private opportunity. IPO, idiotic, preposterous, and outrageous. These are some of the meanings I found of IPOs as to what it potentially truly means if you were to invest in a lot of them without really doing a lot of stress testing and buying only when it makes huge lot of sense and you have a lot of competence in that area, you deeply understand the market, and you have a lot of interest and have been following this space for a long period of time. Other than that, highly speculative environment to avoid as a enterprising investor to participate in IPOs or use any of these bonds or do day trading. Best is to buy stocks in the area of your competence and interest for a company that has a durable moat, great integrity in management, and at a good, fair price. This chart shows that market index funds beat after trading cost all the hyperactive investors, patient investors, very patient investors, probably the extremely patient investors with really high quality stocks. They probably beat by small margin the market index funds. It's probably go index compared to if you are not an extremely patient, enterprising investor. I tried to pull up a little bit of recent data around 2019 overall IPOs, and we can clearly see that 1999, when there was a huge market crash, a huge surge in IPOs, 2007 also huge during the recession. There was also a peak in 2013, 14, and potentially 4 to 500 billion dollars of new IPO activity in this year. These are some of the new companies that are going to market or have gone already to public markets and at a huge valuation. Typically, most of them have earnings per share less than zero. So they're making negative money. So very careful to be investing in this space and avoid IPOs as much as possible unless you deeply understand